Hey, everybody. Thanks for being patient. It's one of those instances where a few things come up, and unfortunately, I didn't want to start the review because my concern was I would have to keep pausing it, stopping it, and if I'm going to, I want to try and minimize as many distractions as possible for the review. Now, it's possible I may have to pause for 3 or 4 minutes, but I'm going to go ahead and start right now. I see everybody's questions. I'm going to try and go in chronological order regarding the questions just to keep it fair. Overall, with today, let's take note of a few things. One of the first things I want to say is I use this chart primarily because this is how Al always did it in the trading room, and I got kind of used to it. But the longer I trade, the more I really just look at one chart. So I have a 5-minute chart here, and I'll occasionally flip it to a 15-minute, sometimes glance at a 60-minute, but not all that often. And anyways, what I will do is clean this up real quick. I usually have a chart here and then a matrix right over here where you can see me. And that's pretty much all I look at. I'm aware of the daily chart and some of the other things, but the reality is on a day like today, the first thing I'm going to do is I really think of two important support and resistance levels on the open. The first one is the first and second, it's really a tie, is the high of yesterday, which whenever I refer to yesterday, I'm always referring to the prior trading day. So if it's Monday, I'm referring to Friday. So when I look at this chart, it's the ES.D. So it's the RTH for some of you, or the day only session for some of you. When I'm referring to that chart, this is yesterday. So it doesn't matter if it was whatever day that was. So if it's a holiday, it's the prior trading day. So one of the first things I'm going to do is I'm going to draw yesterday's high. I typically mark it blue, and then yesterday's low. Those are the first two things I'll draw. And then obviously the next piece is whenever I look for a gap. If we have a big gap up, there's a few things I'm thinking about. One is if you go back to that encyclopedia video webinar that was done, I believe it was done on July the 6th, and you can find it on the Brooks Trading Course website. Just click on videos and you'll find it. But one of the things I talked about there was there's really there's 2 or 3 types of opens you can get. And I really try and keep it, there's 3 types. You can get a, trading range open, where you can get a rally and then a sell off, or a sell off and a rally. So we call that an opening reversal. And then the last one is a trend from the open. I try and keep things really simple whenever I'm trading. So for me, I'm always assuming sideways, so a trading range open. And then the next thing I'm always assuming is some form or a trend from the open. So 80% chance on every day, if you were just to pick a random day, you're going to get a trading range open. And then on top of that, I assume 20% chance of a trend from the open. So when I see a bar like bar 1, I know the range is going to double. You're going to get a measured move down, measured move up, and I look at the gap up. The gap up's really big. Big gap, we're probably going to pull back. It's probably a little bit climactic. So I'm assuming price is going to want to get closer to this moving average. Obviously, the moving average will race up rather quickly because the closing prices are all up here. The next thing I look for in the open is I'm always looking for a swing trade. My preference is always in trading. I'm willing to trade with limit orders. I'm willing to counter trend trade. But my ideal environment is big bear bar on 2, follow through 3 to sell. Or, let's find some other examples today. There wasn't that many good ones. It's mostly a trading range, but couple bull bars here, look to buy. 2 or 3 consecutive bear bars, sell for a second leg. Big bear bar here, sell for a second leg. That's what I'm looking for. Now, I know most of the time the market's going to go sideways, though. So, anyways, what I wanted to say is I'm always looking for a directional bias. Big bear bar on 2. It's always in short. There's no way I want to be long. I'm going to sell. I'm just going to sell the close. And typically, I'll scalp out, but there's nothing wrong with staying short. Anyways, I'm going to talk more about that. But what I wanted to say, the key thing to write down, if there's one thing I want you to get from what I just said a few minutes ago, on the open, there's really 2 types of opens. There's a trading range open and the trend from the open. Obviously, you can get an opening reversal, but I'd really rather most people think in 2 ways. You're going to get a trading range open for the first 6 to 12 bars. And the key with trading, there's 2 types of trade. You can categorize trading or traders into really 2 types. There are discretionary traders, and the far extreme with that would be someone like Al, who keeps it really simple, looks at this chart, and they can pretty much adapt to whatever the market's doing in trade. Another type of extreme trader would be a systematic trader. So somebody that builds systems, or the most extreme example would be an algorithm or a computer program, because a computer program can only think regarding whatever the logic is or the rules of that algorithm or system. But they cannot adapt to what the market's doing. They can just read the logic and it will react on that. And if you're a discretionary trader, you're basically, what you are doing, if you really want to break it down, is you're building your own set of rules for a system. And when I say a system, I mean a trade. So if I'm a discretionary trader, which I like to consider myself a discretionary trader, what I'm going to do is, hey, that's a breakout. Okay. I need to think through a systematic way of selling the close, putting a stop somewhere, and getting in on the move. So what traders have to do and what traders have to do if they're discretionary is they have to find a way to rule out a lot of decisions. You can only make so many decisions at any given one time. So for me, a lot of my decisions are based on always in. Is it clearly always in short? Is it clearly always in long? And regarding the open, I like to assume that you're going to have a trading range open every day. I'm willing to respond. I'm willing to sell if I see it going down. I'm willing to buy if I see the market rallying on the open. But if I assume the day is going to be a trading range, then I'm reducing a lot of decisions. So let's see here. Let's talk about the weekly chart for half a second, then the daily chart, and then I'll talk about the 5 minute. So on the weekly chart, I really think it'll be interesting to see. I think there's potential for an inside bar. We have a sell off that was followed after a rally. We have a big bull bar. We have an inside bar for a bear bar. And you have to think about it like this. I need to update some of the everything on this chart. So let's just break down what's happened here. We have this big sell off that we expect to get a second leg down. So some sort of leg 1, pullback, leg 2. But we have this rally over the past few days. So the August 25th and then September the 1st, 2 weeks ago, we have this rally that's probably going to get a second leg up. So if you're a bull and you bought that close, you're disappointed right here on last week's bear bar. So what are you going to do? You might have bought the close here, scaled in lower here, and you might try and get out, break even, but you might also sell up here. The bears They know that the bulls are disappointed. So what are you going to do if you're a bear? Well, you had to rally here, you had to pull back, and if we rally again, it's kind of like a double top or a second entry. So if I'm a bear and I think bulls might sell somewhere up here, what am I going to do? I'm probably going to sell. So I think overall, I think we're going to go mostly sideways. I don't think we're going to break strongly to the downside. We might, but it's a low one short. I expect probably buyers below. Daily chart, more or less the same. Strong enough rally, but it's a disappointing rally as well. Strong enough rally that I think we're probably going to have a lot of sideways trading, so probably buyers below, but a strong enough sell off last week that I think we'll get a second leg down. So to me, this is all about disappointing bears here on this. I need to fix all this. This is all about the bears getting disappointed on the daily chart. One of the problems with trading ranges is you look at this and you think, well, it's kind of like over here. I talked about this being a second leg trap. It's easy to look right here and say, yeah, I'm going to buy the close of this bar. But you have to look to the left. And whenever you're in a trading range, always remember strong breakout. That's a second leg, middle of the trading range. That can be a dangerous area to be buying. Bear breakout looks not great, but it looks okay. If you're selling here, you're selling in the middle of a trading range and the risk reward's bad, so we could easily bounce. Traders are fading everything. You get a gap, you break out above this bar right here, which was August the 28th. You get a strong bull bar, small second or third leg up to September the 1st, and then you gap down and you close the breakout point. So I think we're going to be sideways. Another thing I want to mention before I officially go bar by bar is I've seen people make comments in terms of, let me get a sip of water first. I've seen people make comments as far as they get frustrated when people in the room or you when I talk on the end of day reviews and they hear the bulls and the bear case, how it's very close to neutral. What's very important to understand is majority of the time probabilities are not, they're pretty close to 50-50. It doesn't take all that much to shift the always in direction. And that's most of the time when you're trading. Most of the chart that you're looking at, if you're going to trade, the majority of the time you're going to be, as Al says, swimming in a sea of uncertainty. So a few Tuesdays ago, we had that very strong rally right here. This is the exception to trading. This is that 10%, 5% of the time you get this very strong trending behavior, but it's still not easy to trade. Most of the time, you get this. You get a lot of overlap, you rally for a couple of legs, sell off, deep pullback. It's all disappointing. So you have to remember if you're ever trading and you think to yourself, this is a for sure trade or there's no way I'm wrong, you need to check yourself at the door because you're missing something. And the reality is you really should not trade at that moment because you are being far too biased about your trade. So if you look at this sell off right here and you think to yourself, there's no way I'm going to lose, I'm going to sell aggressively. Well, it's a possible second leg trap or a failed breakout below a channel. So you always have to be aware. Big bear bar, it might only go down for a little bit and then reverse. So always remember that no matter how strong you think your trader's equation is with your trade, institutions move the market. And if institutions move the market, then that means there's an equally strong institution that's taking your trade and an equally strong institution that's taking the opposite side of your trade. So bar one, we have a big bull bar, follow through, but a big tail, gapping up above yesterday's high. If you're aware of the daily chart, you know we've had a tail on Friday and we're gapping up today, testing the high of September the 6th, which was 43.75. And we came actually within one tick of the high of that bar. Why is that bar important? Because it's a really big bear trend bar. I'm going to go ahead and plot it on the chart just to help kind of, just so we can better see it. It's always fascinating to me how we can look at how you can get such big bars and you get this gap up and this rally, and it's just it's a buy vacuum test of September the 6th. We come within one tick of the bar and then we reverse down sharply on two. So if you were aware of this on the daily chart, you could get a little bit better of an entry price, but you don't need to know that. Big bar one, does that look like a strong stop entry buy? Of course not. You know that there's probably sellers above and we're probably going to go sideways. One thing to think about is I have not checked the CME website. So I don't know if TradeStation's accurate. If TradeStation's data is 100% accurate, it's very accurate, but there can be occasional one tick differences. So that's another point. CME controls the Emini. So no matter how accurate you think your data is, it's sampled data. So if you ever want to look and make sure that your data is accurate, if you ever have a discrepancy on a bar, go to the CME website and look at their data. But bar one, the open is the low tick of the bar, and that increases the probability that we're going to go below bar one. We may rally for a bar or two, but the odds are high we're going to fall below bar one. And because of that, I think there's probably sellers up here. Bar two, always in short, okay to sell the close. Big bear bar. Now, what should we notice right here about this area? The important thing to realize about bar two and bar one is, let me just adjust one thing. The important thing to realize is right here, there's a gap. There should have been buyers below one, and they got trapped on two. One is such a big bar that it increases the odds of a trading range. Why? Because this is not typically how trend from the opens or small pullback trends behave. Three, follow through for the bears, but it's a pullback after the gap up. We gapped up, and bar one is a bull bar, and bar two is a big bear bar, but bar three is a small bear bar. So that lowers the probability for the bears selling the close. I still think we're probably going to test yesterday's high, which is this blue line right here. Four, another big bear bar, but look at the pattern. Big bear bar on bar two, smaller bar on three, and then a little bit bigger bar on four. So what does that tell you? That's climactic behavior. It's a big and it's unsustainable. It's a big bar, small bar, big bar. So in bar two, you have this surge in momentum. Bar three, you have less momentum. And then bar four, another surge in momentum. That's climactic behavior. And that's a sign we're in a trading range. Bar four, good bar for the bears, closed below the midpoint. However, it closed slightly below the midpoint of bar four, not far below it. If I'm a bear and I'm going to sell the close, I want to see a bar like bar two. I want something to close far on its low. What I don't want to see is buying into the close. If there's buying into the close of a bar like four, that means that everybody thought it was better to take profits. And I still think the odds are we're going to test the bar one low. Bar 5, we have a doji, and you can see more profit taking at the high of yesterday. But to me, this looks like some form of an opening reversal. This does not look sustainable. Always in traders, they're short. For me, you're getting near a 50% pullback from the rally from the 72 low on Friday to the high of today. I think it's okay to take profits. Other traders, they might have a stop a couple of points above this bull bar. And they probably would not have gotten triggered here. First reversal up, probably going to fail. Six, what about selling the close of six? To me, I think six is more of a profit taking bar. We had a sell off down to the five low, pull back up to the six high, second leg down to the six low. We're probably going to go sideways. But the channel down to bar six is tight, which means still the first reversal up will probably fail. On a higher time frame, this is just one bear breakout. Bar 7, bull bar, it's a doji, but who's going to buy above the bar? That means probably sellers above. But you can see what's happening to the sell off. Where are the bears selling below bars? Bears were selling below 1 and bar 2, and then slightly below bar 3. But they're buying below bar 4, they're buying below 5, and it looks like they're buying above bar 6. I still think we'll probably go below 7, but I expect buyers below 7. 8, we have an inside bar. What about buying above 8? Some traders might, but you have a small bar and small risk. And more importantly, bulls have yet to make money above any bar. So if you're buying above a bar like 8, I think it's a minor reversal. Probably better to wait for stronger buying pressure. And that's why. 9, we trigger the buy above 8 and reverse down. Possible parabolic wedge, 4, 6, and 9. But still better to see a trend line break. So better to see, here's a sell off, but it's tight. Better to see a trend line break. What about selling the close of 9? It's the same problem with selling any close after 4, 5, and 6. Bears are buying back shorts below bars, and bulls are buying to go long below bars. 10 is a wedge bottom with 4, 6, and 9. It's a reasonable swing buy. Why is it a reasonable swing buy? Again, I'm always thinking about always in traders. So for me, I'm always thinking about the stop entry traders. On bar 8, it's a bull bar. And if I'm a bear, I'm contemplating buying back shorts above this bar. It's not unreasonable. We're probably in a trading range, 80% chance that we're going to get a minor reversal after this trend from the open. And when you look at bar 8, if you buy above 8 and you buy more and you scale in lower, you're probably going to make money. So to me, this is already forming a trading range, and we have support below the 60-minute moving average, this dashed line, and the 5-minute moving average. And that's what happened on 10. 10, reasonable bull bar, okay swing buy, betting on higher prices, but it's a minor reversal. 11, follow through. But look at the bar. We have a tail above 11, and that tail represents selling. I'm always looking at stop entries and looking at who's making money. The 10 high, you can see it's 27.5 is the high of the bar. Whenever I'm measuring stop entries in the Emini, a little trick you can do is add 2 ticks above the bar. So for me, if you're looking to see if traders made 1 point or 2 points, rather than making it real complicated, that stop entry traders need 2 ticks to get filled, because if they buy on a stop 1 tick above 10, their entry price is 27.75. And that to scalp out for a 1 point profit, the market has to go up to 28.75, right? Well, no. The market actually has to go up another tick. So if 27.75 is the entry and 28.75 is a 1 point scalp, it really has to go to 29 even in order for those traders to make money. Hence, if you just add 2 ticks above the bar, and then you can just count the distance. So to me, 27 and a half, I add 2 ticks, that gives me 28. That means bulls need 29 and 30 for a 1 and 2 point scalp. 29 and 30, you can see it went up to 30.25. Bulls were able to make 1 point scalp and they took partial profits. But the bar itself is rather big. It's a 4 point bar, so you know traders are probably going to try and take profits more at 3 and 4 points if they're disappointed. And what that means is the market really needs to go to 32 even for a 4 point scalp. And you can see it went above it on 12. Is 12 a reasonable buy the close bar? You're getting near 50% from the high of 1, low of 9. And look at the bars. Bull bar, average size bar on 11, and then 12. Is 12 an average size bar? No, 12 is a climactic bar. It's kind of like bar 6. And climactic bars are really common in trading ranges because they're vacuums. They're buy vacuum test of resistance. They're sell vacuum test of support. It's kind of like right here at 57. Big sell off, but then it went sideways for 6 or 7 bars. That tells you it's a sell climax test of support. 13, big bear bar. What about selling the close of 13, betting on lower prices? You can, but what about the bulls who bought the close of 12, betting that we would get a second leg up? The rally on 10, 11, 12 is strong enough to make the market probably in a trading range. So for me, when I see a bar like 13, it's a low one short, it's a strong enough bar for a second leg down. I'm not necessarily interested in buying. I'm not necessarily interested in buying the close of 13. However, I'm also not interested in selling the close of 13. And if I am selling the close of 13, I'm going to be really quick to get out. I'm expecting a brief second leg after this bar. And then look at 14. 14 is weak follow through testing the 9 close. If I sold the close of 13, do you think I'm jumping up and down and screaming with joy with the follow through of 14? No. And because of that, the momentum, the momentum's weak for the bears that sold the 13 close. And if the momentum's weak for the bears that sold the 13 close, what do you think they're going to do when they see 14? You know those bears are probably buying back shorts. If I'm a bear and I sold 13, I'm crossing my fingers and hoping that 14 goes all the way down here. And if it doesn't go all the way down here and it does this right here, like what it did on bar 11, then that tells me one thing, and it tells me a very simple thing. I sold low when more traders were hesitant to sell. And I don't want to be an outlier. I want to do what all the other traders are doing. So if the market's going sideways and I'm selling below bars, that's a problem. Bears will buy back shorts and bulls will start to buy. Remember what I said about 13? How I don't necessarily want to buy the close of 13 because we'll probably go at least a little bit lower. And I want to see the momentum stall. Well, the momentum's stalling on 14. So bulls will start buying and scaling in lower, betting that will close the gap at the 12 low. And look what happened on, let me move the chart so I can see the bars better. Look what happened on 15. When 15 closed, you had bears buying back shorts and bulls buying to go long, betting that this breakout point at the 12 low would close. You have now the bulls who bought the 12 low got trapped on 13 and 14. What do you think they're going to do at the 12 low? It's a retest. And those limit order bulls are disappointed and they're probably going to sell out of longs. The bears, they're not dumb. So the bears, what are they going to do? They're going to sell at the 12 low. And that's what will create a second leg down. And let's see here. So 16, bull bar, failed to close above the 15 high. For the bears, they'll see it as a pullback from 13 and 14. The bulls, they see it as a double bottom. They see 9 and 14 or 15 as a double bottom. They want a test of the 12 high and a break above the neckline. But what happened on 12? The bulls that bought the close of 12 obviously got trapped on 13. They may be more interested in selling up here than buying, and that's typically what creates a trading range. 17, bear bar, outside down, tested near the midpoint of bar 12 and above the midpoint of 13, sold off. Probably strong enough for a second leg down and a test near the 14 low. But there also is probably buyers below 15 and buyers below 16. 18, big bear bar, second leg down. 13 and 14. One of the most important things to learn how to do is to count legs. And strong legs get second legs, and just about every breakout gets a second leg down. So when I see a setup, when I see a situation like this, I'm really hesitant to buy here. And the reason is we have a breakout 13, 14 that should get a second leg. And we have a pretty large bear breakout here that might get a delayed second leg. I like to think of this as delayed price action. It's delaying the second leg. Big sell off, we go sideways for 10 bars, and then we get the second leg down here. So, anyways, just wanted to share that. 18, bear bar, breaking below 9, but we've had a lot of buying pressure. Bulls, they made money buying above 10. Another thing to write down, when you have trending behavior and bulls make money above bars, obviously that's for a bear trend. When you have a bear trend and bulls make money buying above bars with stop entries, and they make a reasonable amount of money. And the way I see reasonable is if I buy above a bull bar like 10, and let's say the market goes a measure move up of the bar, like right here. If I bought above 10, put a stop below 9, I was able to make money. It went above 1 times my initial risk. So I deem that as bulls making money. That will increase the odds the market's in a trading range. It's the obvious it's the opposite for a bull trend. So 18, the way I look at 18 is it's a second leg down, but you've often seen me draw this green rectangle for those of you that have watched me for long enough. I've talked about how I like to think about it like this. We had a strong rally where bulls made money. And I like to think of this being an important area. In other words, we're going to form a trading range in this green box. I don't know. I don't know. I never know for how long, but I know it's probably going to happen. And look right here. This area from the 9 low to the 12 high contained the price action for over 30 bars. So as strong as 18, you could argue looks, it's got a big tail. It's a possible second leg trap and a second leg down with 9 and a double bottom. For the bulls, they'll see it as a double bottom, major trend reversal, or a lower low. Major trend reversal. The bears, they're hoping they get a bear breakout below 9, but there's a cluster of support. The 9 low, the moving average, the 20 period moving average, which is this solid blue line, and then this dashed line, which is the 60-minute moving average. It's an input of 221, 221, and that gives me pretty much a 60-minute moving average, which you can see we almost touched over here. 19, failed breakout below 9. We had a tail below 18, tail below 19. The bears that went short below 17, they're disappointed with 18. And 19 is even more disappointing. So for the bears, they really need to stabilize below the moving average. And by stabilize, what I mean is kind of like right here. They need the market to start holding below the moving average. And that's why the first breakout here failed. This was the first close above the moving average in several bars. We've had 17 bars closing above the moving average today, and only 2 bars closing below the 20 period moving average. So is 2 bars enough to undo 17 bars that have closed above the moving average? Probably not. And then 20, we have a low one short. It's an inside bar. Low probability sell below 20 and a low one short, probably buyers below. 21, reversed up, micro double bottom, 19, 21. Okay, swing buy above 21, betting for on at least a couple of legs up. For the Bears, they'll see it as a failed breakout of a wedge or consecutive wedges, 4, 6, 9, and then 14, 18, 21, or 14, 19, 21. Whenever there's a lot of ways to draw wedges, you know you're in a trading range. Always in bears, I would definitely get out of shorts above 21. 22, we have a follow through bar. Okay, swing buy, betting that we're going to go at least a little bit higher. For the Bulls, for the Bears, they'll see 22 as a weak entry bar, therefore, probably a leg in a trading range. But again, always in bears, I'd get out above 21 or a couple of points above 21, betting on at least a couple of legs sideways to up. 23, 3 consecutive bull bars. Good for the Bulls. Probably going to go at least a little bit higher, retesting yesterday's lows. And then 24, we had a climactic bar, bull breakout, closed above the midpoint, but getting back into this cluster of resistance. We have basically a triangle, several ways to draw it. 1, 2, 3, 1, 2, 3. You have to remember all these tails above bars, even though it's part of a breakout. So a tail right here, you have to remember that this is a triangle. This is a bull breakout that failed. So that is a push. 1, 2, 3. 1, 2, 3. And I'm going to steal something Al said a long time ago in the trading room. But what Al said is he likes to think of price action like melted plastic. And the reason for that is it never looks exactly the same. No two charts are going to be identical, but they can look very, very close. So good is good enough. If it looks close to a wedge or a triangle, it probably is. 24, testing the apex of this triangle right here, which is expected. Therefore, probably going to find resistance not far above, but after 4 consecutive bull bars, probably buyers below 24, scaling in lower. And 25, inside bar, probably buyers below, but the bulls that bought the 24 close, disappointed with 25. And you know the market's probably going to go sideways. 24 is a climactic bar, and climaxes typically lead to 1 to 3 bars of sideways trading and not reversals. So buy climax, sell climax, it's a doji on a higher time frame, rally to 12, sell off to 14. It's a climactic reversal, rally, sell off, it led to sideways trading. Like I said, 25, you can call it an inside bar, triangle, you can call it a 1 bar, possible final flag. We went above 25, but high ones, especially high ones with bad signal bars like 25 and at resistance, typically lead to more sideways trading and sellers above. And that's what happened on 27. 27 for the Bears, they see it as the second leg down. First leg being the high of 24, low of 25, pullback 26, second leg down 27. For the Bears, is it sell to close? I don't think so. We have a tail on 27 and we're near support. The stop entry price of bar 21, we're near the bar 21 low. And with the tail on 27, you have to be prepared for possible bad follow through on 28 and reversal up. Possible higher low major trend reversal, which is also called a head and shoulders top, left shoulder, head, right shoulder. Bear bar 28, but weak follow through in a micro double bottom with 27 and 28 increases the odds that we may reverse up. 29, bull bar Middle of a tight trading range, not ideal for bulls or bears, but I still think we're probably going to rally. 30, you can call it a retest of bar 28, another inside bar. Low probability sell below. If I had to do anything, I think it's a better buy above 29, but it's a tight trading range. We had a 20 gap bar buy above 21, so possible final flag, but strong rally, pull back for a couple of legs, probably forming an overall trading range. I think this kind of looks similar to gold. Let me see something here. Not really ideal, but it's sort of the same overall logic. We have this rally, and in this case, it was a wedge, 1, 2, 3, bull break out of the channel that failed on this bar, 315. It's a 15-minute chart, and we had this strong trend line break. So think of this as the gap. This is the gap up on the day. We sold off for a couple of legs, and then finally we got this strong rally. Now, this strong rally is enough to make the market always in long and lead to higher prices, right? Sure. But whenever you see bars, look at this. This breakout looks almost perfect. It's a very good looking entry bar, no tail below, small tail above. Another big bull bar here, small tail below, almost no tail above. And you think of that and you think, gee, I finally got this. I'm going to buy the close here, stop down here, go for my measured move, just like Al says I should. And I'm going to make money. So I'm going to set a target up here at 56 even. Right thing to do, right? Wrong. It's not the right thing to do. Look over here. There's disappointed traders. The reason why major trend reversals work is you have a surge in price. You have price moving in some directional way. Majority of the bars above the moving average, just like today. Majority of the bars above the moving average. It rallies, starts to pull back for a couple of legs, forms a trading range. But even if we get up here, it's probably going to remain a trading range. In this case, what happened with gold is, and this is pretty common with gold and crude oil, but we had this rally, bear breakout, so bear bar, lower high major trend reversal, and then strong follow through. And then we sold off for a couple of legs. So the point with that is I think we'll probably try and rally. The other problem I see with the bull case right now is right here. So what is that? That's the gap from the 1 low to the 3 high. Typically, there's buyers below 1. And that means whenever you see a bar like 1 and then a brief sell-off, you have to wonder if it's a sell climax that leads to sideways trading. 31, doji, probably going to lead to more sideways trading, but we had a triangle here. We have another triangle here with 17, 24, 31, 21, 27. So I'll just go ahead and draw that one. There's the triangle. Here's the triangle. So may go more sideways. 32, breakout above the triangle. Are we always in long? We might be. Strong enough bull bar. You can probably buy the close. Better to wait for follow through. Follow through 33. Do you buy the close? You might. It's a weak follow through bar. Tail above 32. Tail above 33. Some bulls, if they're buying, they might put a stop. Maybe a measured move down of this bar, or put a stop maybe 3 points below 33. Betting that if bears make money selling below 33, it's a double top with 24 and a second leg trap. Bear bar 34, so that's kind of the problem with buying up there, double top. Follow through with 35, but we still have not gone down that far. It's about 50% of bar 32, so may not go much lower. And then 36, strong bull bar, really common in a trading range. You get a pullback that makes you think the market is reversed. And then right before you look at the market and say, the bears need one more bar to convince me it's always in short, bulls come out of nowhere and buy aggressively. So why is that? They're doing it because you have all these limit order traders looking to buy right here. They're buying the breakout gap 26 and a half, and the low of this bar is 26.75. You have all these limit order traders waiting to buy, and as soon as it retests that price level, the market races up. Here, same thing. Bar one was a possible climactic bar. You have some bulls who just buy the close of the bar. They buy the close saying, yeah, bears need follow through. So I'm going to buy the close. Some traders could call that market makers. They take the opposite trade of the breakout, and thus they're making a market and providing liquidity. So bulls buy here. They get trapped on 3. Some try and get out. They don't get filled. But watch what happens. The close of this bar is 33.75. And the high of bar 12 is 33.75. You can argue that the low, 33.5, bulls bought the low, and the market went one tick above. Doesn't really matter. But the point is, we're testing breakout points, Strong bar 36, but a possible wedge 27, 32, 36, or 24, 33, 36. Probably going to go sideways. 40, bull bar, still probably more sideways. Possible small pullback trend. The bears have not really made any money below bars, maybe below 25, but not clear. And they really haven't made money ever since arguably 25. So if you're selling below 34, you're losing money. If you're selling below 37, you may not make money. And you have to wonder if this is going to lead to an upside breakout. 40, high one buy, probably sellers above, and that's what happened on 41. 41, doji, probably going to go more sideways, testing the close at 36. Bulls buy the close at 36. And you can see what happened. It tested near it, sold off. 42, bull bar. The bears are not getting a strong stop entry. Whenever I'm looking to sell, which in this area I was looking to sell, but my concern was this right here. We have obvious targets above the one low. And because of that, I need a sign of strength. I need a good signal bar to sell below. I'm not just going to sell just because the market's going higher. 42, 43, probably going at least a little bit higher, and we'll get to the one low. $44 doji, and then 45 an inside bar, but small pullback trend or small pullback rally. It is technically a small pullback trend, but I really like to call it a small pullback rally because we're in a trading range and this is not really a trending environment. 46 bull breakout above possible wedge or bull breakout of a channel, but the bears are not getting what they need. And as strong as 46 looks, it's probably more likely a buy vacuum test of the one low. 47, follow through, probably going at least a little bit higher. 48, follow through, but a lot of overlap with 47, getting close to the one low. And then 49, big bull bar, probably exhaustion. And there's probably sellers up here. You had bulls who bought the close of bar 1, and they got trapped on 2. So there's layers of resistance up here. 50, is it still buy the close? You have bulls buying, but the bodies are getting smaller. Plus, it's a micro channel since 43. So that's basically a 7-bar micro channel. And the odds are we're probably going to pull back pretty soon. 54, bear bar, closing on its low. Always in bulls. I'd get out below 54, or certainly after. I'd get out below 51, or certainly after 52. So why is that? Because even though we'll probably go sideways, we could easily reverse down pretty quick. So tight bull channel, that is correct. But it's also a bull breakout of the bull channel. And because of that, here's one way to draw the channel. The bottom of the channel is somewhere over here. That may not be exact, but we could easily break down here and go lower. The odds are we'll probably go more sideways. And then 53, high one buy above 52. It found partial sellers. Bears sold above 52, formed a bull bar, and you can see what happened. Bears still made money. Whenever I'm fading, if I'm looking for a swing trade, then I'm going to hold for a couple of legs or see what the market gives me. I'm looking for a stop entry. If I'm trading with limit orders, I want to be in and out, so it's kind of like you know, you're trying to be very as precise as possible and get in and get out. If I'm buying the 12 low, which when the bar's going down, ideally I would not. But if I'm buying down here, I'm betting that this retests the 12 low and I can make money. And that's the only thing I'm doing. If I am, and same with any of these. 55, second entry short, but bears, where have the bears made money since bar 25? They haven't. So the market's gone 20 bars without traders making money below bars. And if they're not making money below bars, I do not want to be the first trader selling below bars. 26, second entry buy. We went down on 51, 52, pulled back 54, second leg down 56. Probably going to go at least a little bit higher, but bad buy signal on 56. And that probably limits the upside. We still probably have to get up to the one close. So I'll make that blue. 57, strong bull bar, but testing the high close of 50. So this might be more of a sell zone than a buy zone. 58, follow through. But what do you notice about 58? I just kind of gave the answer away. You have a bull bar by scrolling to the right. If you bought the high of 56, or excuse me, if you sold the high of 56 at 37 and a half, the low of this bar is 37 and a half. So it touched traders' break even price. Some traders, if they sold the high of 56, excuse me, this bear bar, if they sold the high of 56 at 57 and a half and scaled in higher, maybe 2 points higher, 58, 59 and a half, so you could see what happened. Bears sold the high of this bar, 56, at 37 and a half. If I'd been saying 57 and a half, I apologize. I meant 37 and a half. So bears sold the high of 56 at 37 and a half. And they sold more 2 points higher at 39 and a half. And look at the high of this bar, 39.75. So bears were able to make money selling 5 ticks above or 4 ticks above the 56 high. And then the low of this bar, bar 58, tested near 57 and a half, but did not let the bears out. And because of that, some traders will look to just get out break even on the entire trade and move on to a new trade. And that's in part what's happening on 60. Other traders will stay short. But in general, in situations like that, I'd look to get out. A lot of overlapping bars, resistance not far above, but we may have to get there. So probably going to go sideways. I think the important thing to remember is we're holding above the moving average for a lot of bars. 33 to 60, we're holding above the moving average for 27 bars, and that's a sign of strength for the bulls. 61. Doji failed breakout above 50 and 51. You can also, let me say this is a wedge. This looks like a ledge. 40, 40, and 40. So you can call it a ledge. Probably going to break above it and pull back. But bad entry bar for the bulls that bought above 60. So probably going to go sideways. 62, more overlap. So more sideways trading. The bulls, if they're staying long, they're hoping for an upside breakout. 63, bear bar failed to close below all the bars to the left, so probably more sideways. And really, this is a limited order market, so traders are fading everything, buying below bars, selling above bars, market's going sideways. 64 bull bar, but traders sold it, pulled back, and 66 doji. And I'm just going to kind of scroll forward, but traders buying below bars, selling above bars. Eventually, 69 touched the moving average. Traders started buying below, and then we had a bull bar on 71. What about buying the close of 71? Some traders might. You can argue it's a bull break out of a tight trading range, but you're so close to resistance. You may have to get to the high of yesterday. Excuse me, you may have to reach the high of bar one, but even then, it's hard to justify it because the bar itself is 4 points and your profit target is only is maybe half the size. So can you really go, can you justify buying for 4 points and only going for a 2-point scalp? To me, that's a low probability trade. 72, disappointment for the bulls that bought the 71 close. And I thought this was really interesting price action. If you bought the 72 close at 41.5, look what happened at 72, 73, 74. The market's not allowing you to enter. It's not allowing you to get out at the 71 close. And because of that, the market may have to pull back here. In other words, the market may go down a little bit lower. You could have bulls. You can have bulls. Bulls might panic out of longs and start selling out of longs. But the reality is probably going to go sideways. And then we sold off here. But as strong as the bears looked, we had all these tails. And this was just a sell vacuum test of something. Maybe the close of 46 right here. But either way, it was a sell vacuum. And then we reversed up. And look what happened. Let's see if we reached it 41.5, 41. We did not reach the close of 71, but we came close to it. Always in. I thought it's always in short on 1 or 2. And I think it's okay for bears to exit above 8. If they do, they don't sell again, or bears exit above 10. Bulls, they can buy. But if they do, 12 is a little bit tricky. It's giving you a decent profit in what's likely to be a trading range. And because of that, you'll have traders take their profits. If I was a bull and I was swing trading always in 13 starts to sell off like it's doing, I'd be pretty quick to get out. And I'd certainly probably get out below the 12 low or maybe a point below 12. But I'm certainly not going to let it go against me. Always in short below 13 or 14? I don't think so. I think the bears needed to do more. So this was more likely to be a trading range, which meant buyers below. Bears, they can sell below 17, but tough to do. It's an okay swing short. But then after 18 and 19, if you're smart, I think the bears that were smart, they bought back shorts below 20, and bulls started buying below 20, betting that we would stay near the moving average and reverse up. Always in bulls, buy above 21. Always in bears, get out above 21. And they really don't have to get out of shorts here. So there's really no reason to get out of shorts. Some might, but it's really not clear. 5-bar micro channel to the 25 low, probably buyers below. And 27 never triggered. And plus, I think 27 is not enough to make the market always in short. Still always in long, 32, 33. Do they get out below 34? I don't think they have to. It could just be a retest of 31. And typically, if I'm holding long below a bar like 34, I'm going to use a stop, maybe a measured move down of the bar or a little bit above it, betting that bears will not make money below the bar. An easy way is just put your stop below this bar, 32. 37, same thing, possible small pullback. trend where small pullback rally, bears not making money below bars. So the bears do not have to exit below 37. And 51, bulls, and I said bears, bulls do not have to exit below 37. 51, same thing. I think it's okay to exit longs below 51, but probably a minor reversal, which means you will have bulls staying long. And then here, if I'm swing trading, I would just get out at some point. I don't think it's worth holding. What about buying above 71? I think it's a really tough call. You have a triangle. Tight trading range is always a triangle. We failed to break out to the downside. We tried to break out to the upside. Plus, you're so late in the day. It's basically 2:30 Central Time, 3:30 Eastern Time at bar 72. I don't think it's worth doing anything. Had I bought above bar 71 and I'm swing trading, I had to get out on probably the third close, certainly by the fourth. And that's probably it for stop entries. Limit orders, I thought there were sellers above 5, buyers below 8 or 6, 7, and 8. Probably buyers below 12. But again, what you have to remember is if you have a limit order to buy at the 12 low, it's not really the greatest buy, because if the market goes down to 12 in one bar, that's a surge in momentum, and that increases the risk of lower prices. But I did think there were bulls buying below 12 using wide stops and scaling in. I thought it was better to do what Al calls a reach trade. So you're reaching out to the target. So in other words, instead of buying the 12 low, what I like to do is buy a certain distance below 12. And preferably, I'd rather wait and see the follow through after 13. 13 is enough of a surprise. We'll probably go at least a little bit lower. So I'd rather buy something like the close of 14, and probably sellers somewhere above 15 or 16. Bulls probably buying below 9, 18, or 20, buying below 25, 26, buying below 33, buying below 37, buying below 42. I did think there was buyers below 50, but a very climactic micro channel. And this is obviously a trading range. You have a leg in a trading range that starts to form a trend. And more often than not, you can think of that as kind of a second leg trap or a bull breakout above a bull channel. More often than not, that leads to sideways trading. And you can see we went sideways here. And then it's really just buyers below everything, sellers above everything. If you're a really aggressive limit order trader, especially if you're a computer algorithm, like a high frequency trading firm, what they would be doing is buying below everything, scalping, selling above everything, scalping. So if you're really aggressive, you buy below, you buy 1 point lower, 2 points lower, you take your profits, you sell above, sell 1 point higher, 2 points higher, take your profits. And you do it on every bar. And you're trying to rack up as many points as possible before you get trapped. So if you did it from here to here, and then, maybe you get trapped here, you sell above this bar, scale in, who knows? But either way, you would make more than enough to offset the loss. For buy the close, sell the close. I thought it was buy the close on 2, 3, or 4. Sell the close 2, 3, or 4. I would not sell the close of 6. I thought it was better to sell a pullback. But if you did sell the close of 6, it's better if you can scale in. Probably buy the close of maybe bar 11, but it's pretty aggressive. And if you buy the close of 12, it's a little bit dangerous because 12 is a very climactic bar, and the market was not clearly always in long. So you have 10 and 11, which is a pullback, but it's a strong enough pullback in a bear trend, the bear trend being the 1 high to the 9 low. Strong enough pullback that we're probably going to get at least a small second leg. But then when you get these really big bars, I like to think of as an emotional bar. Traders are on the sidelines. They're looking to sell or they're looking to buy, but then they see a bar like 12, and it's kind of emotional. It forces you to think. And what it does is it causes traders to jump in to the market. Now, obviously, smart traders use it to take profits, but you have to look at that bar and realize that it's momentum. It's a vacuum test of resistance. So as strong as this bar looks, it's really more about bulls stepping aside. Excuse me, it's more about bears stepping aside. Bears are selling, they're looking to sell. But if everybody thinks the market's going to get up to the two close, nobody's going to sell under the two close. They're going to move their limit orders or sell orders to sell at the two close. And bulls know that. They're not stupid. So the bulls, they're going to buy aggressively all the way up to the two close or wherever that resistance is. And that's what causes the sharp reversal on 13. Now, had I bought the close of 12 and this bar starts to go down quickly, I'd probably look to get out. I want to see something actually. So this is 10:30 to 10:35 on a 1 minute chart, Central Time. There you go. So do you see what this was? It was a parabolic wedge. One, two, three. Whenever I get a big bar like that, there's no way I'm staying long. Closing below a lot of bars to the left. So let me go back to this. There's a good wedge, bull break out of a channel. Yeah, so here's the parabolic wedge. Let me remove myself. There's the parabolic wedge, big bar one. And the close of this bar on the 1 minute chart is 30 and a half. There it is. So a lot of traders, by the time this got down, 70% of this bar or 60%, after it retraced 60% of this bar and pretty quick, a lot of those bulls got shaken out and they just started selling. So if you're really quick, maybe you could sell, but I think most traders, I would just put a stop below 12. And if this started going down too fast, just get out. But the only problem I have with buying 12 in the first place is it's really bad risk reward. If you're buying 12 and your stop's all the way down at 9, you're kind of buying in no man's land. It's right where you have bulls and bears competing against each other for who to see who's going to own the chart. Are we going to get all the way up to here? Are we going to get all the way down here? You're kind of in that neutral zone. It's kind of like in if you think about like trench warfare, the middle of the trenches was always called no man's land because it was the most dangerous area on excuse me, it's the most dangerous area in the battlefield. And then I thought in here, it's really more opposites. So you can sell the close 18, but not ideal. If you're selling, you're getting out really, really quick. And typically, after 3 or 4 bars down, traders buy. After 3 or 4 bars up, traders start to sell. And I thought it was always in long by the close. I thought it was more by the close, maybe 47, 48, 49. But at that point, you're getting a bull breakout of a channel right here. There's one way to draw it, another way to draw it. Doesn't really matter. But either way, you're getting a bull breakout of a channel near resistance. This big bar two. Whenever I'm trading, I'm always looking at the chart and looking for those big surprise bars that trapped a lot of traders. Because I know if I'm a bull and I got trapped on two and I'm scaling in lower, I'm going to feel a lot of pain. And if I did scale in lower, if the market allows me out at my original entry, I'm going to, I'm certainly going to take it. And if I'm a bull, everybody sees what happened here to the bulls that bought the one low and more lower. So those bulls are going to sell out of longs. Those bulls that sold out of longs are not going to be interested in buying again at that price level. And then not really buy the close, sell the close anywhere in here. Okay, let me take a look at a few questions. Okay, so question. Thoughts on buying the close of bar 32. Let me fix the chart so it's easier to see here. So thoughts on buying the close of bar 32 here, stop below 32. The pullback can be deep sometimes, but trading always in here is reasonable, right? Yeah, so in a trading range, well, there's two things. I thought it was okay. For one, the market was in a trading range here, and arguably we became always in long, or we were already always in long on 32. The only thing I would say about buying the close of 32, I think it's okay to have a stop below 32, but when you're in a trading range, there's one thing that separates trends from trading ranges. In a trading range, you should expect every gap to close in a trading range. So remember what I said about the bar one low? I know it sounds crazy, but bar one, whenever you get a sideways price action on the open, the odds significantly go up that you're going to have a trading range day. And this sell off was too climactic and it was big. It's a climactic sell off following a gap up. So I thought the whole day was going to be mostly a trading range. I just didn't know when we were going to get back to one. But the point is, back to 32, you have breakout points, the high of 31. If you're buying the close of 32 and you see that big tail, there's two things. There's two problems I have with buying the close of 32. And it's not a terrible buy. The first problem is the tail on 32, the high of the bar. What do you think happened at the close of 32? There were bulls who started selling out of longs. They took profits at the close of 32 and the bears started selling. So if traders were so confident that the market was going to go higher, traders traders would have bought all the way into the close of the bar and they didn't. Most bars in a trading range, most breakouts, if you just measure everything, you can buy a lot of 50% pullbacks of moves in trading ranges. But I don't have a problem with it. I think my problem with buying the close at 32 would be getting out below 34. How many candles should we see to say for context? It really depends. I think that most traders, I think a lot of traders, I think the most important thing traders should try to identify, if we're just talking about, let's say, the, something that has, let's say, an open and a close, like an equity or a stock or something like the S&P or the Emini. A lot of traders, I would focus on the opening range. So to me, when I'm trading, I talked about it earlier. I'm looking at the high of the day, the high of yesterday, the low of yesterday, and then I'm paying attention to the opening range. What are the first 6 bars doing? And I'd really challenge everybody. If you're frustrated with your trading, consider not trading for the first 6 to 12 bars of the session. And you'll be surprised at how much information you can gather just from the first opening range. A lot of traders, the problem with the open is, one, the bars are bigger, and usually you face several reversals on the open. So if you take 1 or 2 losses on the open, they're usually going to be bigger than normal. And the other problem is the range contracts. So you have these big bars here, and a lot of tight trading range price action here, and then a lot of small bars here. So the range, I mean, if you really think about it, basically 100% of the range, and this is actually interesting, the 100% of the range was formed in the first 21 bars of the day. So that tells you how much the range contracted. But as far as how many candles to look back, I'm looking more at context. In general, 20 candles, 30 candles, I don't really know because it really depends. Here, I'm looking at the big gap up. I'm expecting a trading range open. We have this big sell off. So I'm aware of all of this and I might be able to see it on my chart. But guess what I'm paying attention to? This right here. We had a gap and we had a lot of traders selling at the trading range. What am I expecting here? We had a big sell off. So even if we rally up to here, we're going to be in a trading range. What's the context down here? The bears that have been short for 20 bars or ever since bar two, they're probably buying back the remainder of their short position, which means we're probably going to rally for a couple of legs. Question: how important is it that bears cannot get back to the 31 high during bar 35? So how important is it that the gap at the 31 high, 26 and a half, and that stayed open at the low 35? Does that hint towards a bull trend? Yeah. Bull trends trap traders. So if bears sell the high of 31, scaling higher on 32 and 33, what do you think happened to those traders on 36? We tested the breakout price, and actually we closed a tick above it. So the high of the bar is 36 and a half. The low of this bar is 36. Excuse me. The high of this bar is 26 and a half, bar 31. The low of 35 is 26.75. So there's a one tick gap and the market rallied pretty strong. That's a sign of trending behavior. Okay, question. Today I sold above bar 5. I think that's reasonable. That's a good trade. And bought below bar 33 here. I think that's okay, but remember what I said about the breakout price. I would be prepared for a test of the 31 high. So those trades are fine. Selling above 5, buying below 33, but I think it's better if you can scale in. And on Friday, I bought below 2. I think that's okay. I took that trade and got out at the high of 2 or maybe one tick below. So on Friday, I bought below bar 2. And this is the person's question. On Friday, I bought below bar 2, sold above. So bought below 2. I sold above bar 29 here. My only problem with selling above bar 29 is you're selling really low in a trading range after two legs down. Leg 1 to 28 or 29, pull back leg 2 to 30. So for me, actually, I'm sorry, I misread that. Let me just start the question over. So they sold, question, I sold above 5 here and below 33 here. I think both of those trades are fine. 33, better to scale in. And on Friday, I bought below 2 here, which I think is fine. And I sold above bar 29 here. I thought that was reasonable, selling above 29. I risked 4 points to get 4 points. Do you think it's mathematically okay to fade low one, high twos after an impulse? I think fading low ones and fading high ones is a reasonable strategy. Now, as far as what do you risk? Risking 4 points to make 4 points. When you're scalping, the market's not always going to give you what you want. A lot of these trades are really quick, and it really depends on the momentum of the market. So, for example, I do remember buying the low of bar 1. Actually, I take that back. I remember buying the low of bar 2 on Friday, and I bought the close of 1, and I gave it 2 or 3 minutes, and I got out break even. And then when 2 closed, I bought the low of the bar because I thought it was a weak stop entry short. I bought below and scalped out here. Now, for me, the way I look at low ones and high ones is this: if I'm buying the low of the bar, especially if the move is if the momentum in my direction is pretty strong. So if we have a decent rally and I'm buying the low of the bar, the market should not fall a measured move down of the bar if it's going to work, if it's in a strong move. So if I buy this low, the market should go up here before it goes down here. And if I'm fading something, I'm going to scalp out. I want a stop entry to swing trade. So if I'm selling above this bar is smaller, bar 29, and the context is decent for second leg. The bulls that were buying got trapped on 27, 28. Reasonable to expect a second leg down. So the way I look at it is this: you can probably put a stop up here. I might put it a little bit higher, but either way, if I'm selling this bar, I don't want bulls to make money above the bar. So there's nothing wrong with putting a stop, a measured move up of the bar. And other than that, the only danger to fading low ones or high ones is situations like this. When the channel is really tight is when it becomes more and more dangerous. I'm trying to find an example. So here's an inside bar. Let me just see. Yeah, it's an inside bar. It's an equal high. 42 is an inside bar with 41. It's an equal high. If you sold above the high of 42, you actually would not have got, I don't know if you got filled. You may have. The market may have triggered the buy, turned down and gone up. But either way, this is an example. If you sold it, you're generally my target is the low of the bar. And sometimes it's the midpoint, depending on the strength. Let me find an example of a bad high one. Okay, here's an example of a bad low one. So here's an example, this bar right here. I'm going to turn the screen off and turn on the bar counter. Okay, so you see 14. It's a doji and a wedge with somewhere in here. So 3, 8, and 12. Bulls reasonable to buy below this bar. But if you're buying the low of this bar, the channel down is fairly tight and there's open gaps. Open gap here, negative gap right here. So if I'm buying the low of 14 and then 15 is a bear bar closing on its low, I would just take the loss. It was reasonable to buy the 14 low. Now it's possible if you bought the 14 low, remember what I said? If I'm buying the low, I might put a stop down here and set a target up here. It's possible the traders that bought the low of this bar at 20.25, the market went up to 23.5. So some traders, they were able to make 3 points. They bought the low, they scalped out for 3 points. But fading a low one or a high one is a get in, get out trade. You're taking that little bag of money, whatever it is, and that's it. So if I'm buying the low of the bar and I couldn't scalp out in time and it turns down, closing on its low, I'm out of the trade. I'm going to look for a few more questions and then I'm going to wrap up the webinar. This is actually reasonable. It's a good question. In general, okay, question. In general, when you're entering on stop orders, would you say it is reasonable to almost always exit if you are disappointed by an entry bar? Yeah, there's plenty of traders that do that. So let's see here. That is what actually causes trading ranges. So you sell the close of 1, okay? Now, if you're selling, a lot of traders, what they will do is they'll sell the close of a breakout or the follow through, and they'll be pretty aggressive. So they'll sell here, and they're hoping for just a really big give up and a sell off to yesterday's low. They're hoping for something extreme, but they know they're not going to get it. So they sell the close at 2 and 3. Maybe they're disappointed, or maybe they sold below 2. It doesn't really matter. But either way, if they sold below 2, 3 is a small entry bar, so it's disappointing. 4 has a big tail. What do you think traders are doing? Traders will start lightening their position. They'll start to reduce their position. Then you see this bar right here, bar 5. What are traders going to do? Traders may not exit above here because of the strength. However, they will start to buy back shorts at the midpoint of the bar, the low of the bar, and that's what you see 6. What are traders going to do? They're going to start reducing their position even more. You see a bull bar here. What do traders do? They'll start to exit. Now let's look at a different situation. You buy the one low, you're disappointed by these 5 bars. What are you going to do as the market goes higher? You're going to reduce your position. And eventually, these consecutive stop entries, buying above 1, here's a stop entry here. 9, there's a high 1, that's a stop entry. But the market is having a lot of overlap. For me, whenever the market is hard to stay long, in other words, whenever it's difficult to exit and re-enter, that tells me you're in a trading range. If I bought here, it's really hard to want to buy the close of bar 7. If you buy above 9, it's really hard to want to buy the close of 11. Now compare that to a couple of weeks ago over here. You can almost buy anything. Here, if you bought 18 and you scalped out 2 bars later, you can just buy any bar that you want and you're probably going to make money. That's a sign of a strong trend. That's different than if you sell the close of 52, betting on a wedge, higher high major trend reversal, 1, 2, 3. It's really a nested wedge. 3 pushes up, 3 pushes up. So if you're selling, the shape's not perfect, but it's still a wedge. And you're selling below this bar, it's not the world's craziest stop entry, but if you sold below it, you see the follow through on 53, but then you see the terrible follow through 54. You have bears who will start buying back their shorts. And when you have bad follow through, you have bulls that'll start fading. Remember what I said about bar 13? I mentioned how I wanted to buy betting on a trading range, but 13 was too strong of a bar. I may have bought the close of 13 and I ended up deciding it was a mistake and I got out for like a pretty much break even, maybe a 1 tick profit, 1 tick loss, break even. I can't remember. And then I waited for this bar and I bought again. And the reason I bought was it was disappointing. If you're a bear, you sold this close, you're hoping for a plunge down into yesterday's range, Friday's range. And when this bar is weak, a lot of traders give up and the market reverses. Okay, question. Do you ever trade in the first few minutes after announcements such as Fed, or do you prefer to avoid the higher volatility? For example, the breakout last Wednesday, 30 minutes after the open. Let me go to last Wednesday. So that was the 6th of September. Oh, so I'm assuming you're talking about this big bear bar. For me, I pay a lot of attention to the Fed report. I don't read the Fed report, but whenever there's a Fed minutes that's released at 11 o'clock Central Time or 12 o'clock Eastern Time, I've got that backwards. Whenever the Fed report is released, it's 11 o'clock Pacific and 1 o'clock Central Time, 2 o'clock Eastern Time. I pay attention to that. And typically, if it's a really big report, there's really two reports where I really will for sure stay out of the market, and that's the CPI, the 7:30 Central Time or 8:30 Eastern Time reports, like the CPI report or I forget all the others, the unemployment report. I will stay out of the market there. And other than that, for the Fed report, kind of the same thing. I typically like to wait 10 minutes after the report to enter. I used to be really I used to really want to trade Fed days, and now I'm not really a big fan of Fed reports. I'll trade those days, I'll watch the day, but for me personally, I would rather I'd rather just have normal price action. And other than that, I pay attention to, I've got a bookmark to, let me see what the website even is. It's Market Watch calendar. It's just the US economic calendar. I look at it every day just to make sure there's nothing crazy like a Fed report. And I try and avoid these bars. So I'll often, I think every Tuesday, maybe every Wednesday, there's an there's typically a 10 o'clock there's typically a 10 o'clock Eastern time report the first 30 minutes of the bar. I might try and just stay out of the market just because you can get a surprise. But when I see this kind of a bar, it's a sell to close bar. It's a big bar, especially when 8 looks weak. It's a sell to close bar, betting for a second leg. I might try and fine tune my entry. So climactic bar, rally on 8. We may get a small second leg after bar 8. So leg 1 to the 8 high, pull back to 9, leg 2 to 10, and then a second leg down. But it really varies. But when I see a bar like 7, I'm looking for a second leg down. So where do we go tomorrow? I think that we may try and pull back here. As strong as this rally is, whenever there's tails, sometimes it can be helpful to go to or like this. We've had strong buying pressure on over the past few days. But you can see this rally and this chart right here, it's the same thing. This gap up, that's buying pressure. As strong as this rally is, we may get a small second leg, but I suspect the bulls will be disappointed soon. I don't think we're going to gap up. We could. I think more likely big up, big down, probably sideways, 3 bars up. We may pull back for a bar or two. So I think tomorrow we'll have more disappointment price action. All right. Thanks everyone for watching, and I will talk to everybody soon. Tom Gillens, you're asking if you can type your question in real quick, I'll answer it. I'm not sure where your question is. Oh, I see your question. Okay, so Tom Gilland, you're asking just a general question in terms of gaps that I should be looking for on the chart to give clues on where price needs to or wants to go. Are there any missing from these? I'm not exactly sure the question you're asking. Let me take a look here. So you followed up with, I look for micro gaps from trend bars to its prior small body gaps between bars and moving average and breakout gaps. Are there any certain types of gaps are there any certain kinds of gaps you're consistently looking for? No, it's basically what you mentioned. For me, on any given chart, it's exactly what I've talked about. I'm always paying attention to who's making money, who's not. So in a situation like this, if you bought the 3 low on 7, you got trapped. And look what happened at the 10 high. The market did not allow the bulls who bought the 3 low to make money. if you bought the 8 low and you scaled in lower on 11 or 12, the market tested back to the 8 low on 14. So the bulls were at least able to make money, but not a lot of money. And then I'm paying attention to the moving average. Remember what I said today? We're holding above the moving average for a lot of bars, so we may go sideways. I also mentioned that stop order bears are not making money below bars, and that increased the risk that limit order bears would get trapped. So, as far as gaps, in a trading range, I expect gaps to close. In a gap, a gap is a breakout, and a breakout is a gap. Price going one tick above or below the prior bar is a breakout. So that's what I'm always measuring. But to answer your question, and Tom, maybe to give you something to think about, is what I'm paying attention to is how easy is it for limit order bulls and limit order bears to make money? How easy is it for stop order bears and stop order bulls to make money? If limit order bulls are making money buying and selling, you're in a trading range. You're in this environment right here or down here. If stop entry bulls are only making money, you're in a very strong trend, which means limit order traders will not make money. Okay, thanks everyone for watching, and I will talk to everybody soon.